rate or inflation. That's their big achievement. In the 90s, if you remember, the Reserve Bank successfully transitioned India from a largely state-controlled economy to one where you had market-determined exchange rates and market-determined interest rates. A largely government-owned banking sector was transitioned to one with healthy, competitive private and public sector banks. Now, to salute this effort today, we will be shortly honoring 3 former Reserve Bank of India governors, Dr. C. Rangarajan, Dr. Bimal Jalan, and Dr. Reddy, for their iconic contributions to the Indian economy. The current governor, Mr. Shaktikanta Das, also has a distinguished record. He has been named the top banker globally by Global Finance, the magazine, for 2 years in a row, exactly for the same thing, for his outstanding performance in inflation control, economic growth, currency stability, and interest rate management. So growth has always come with good macros. In step with the central government, the Reserve Bank led, Mr. Das led the Reserve Bank to infuse liquidity into the economy during the dark COVID days, but was quick to withdraw it in time when normalcy returned, and therefore did not suffer the consequences of high inflation, which many so-called developed countries are going through and are, barely able to control. Sir, Governor, we at CNBC TV 18 have been covering the Reserve Bank ticker by ticker, headline by headline, going back at least 100 monetary policies. And we are honored that the Governor has come here today to be part of our Silver Jubilee celebrations and to deliver the keynote address. May I also thank Deputy Governor Ravi Shankar, as also former Deputy Governors Shamla Gopinath, Mr. Kanungo, all of them for coming in so that we feel that we did a good job of covering the Reserve Bank. Ladies and gentlemen, with these words, may I present to you Governor Shaktikanta Das.
I'm just trying to adjust this to suit my convenience. I hope I'm audible. Is that okay? I'm audible? Yeah, thank you very much. Sri Rahul Joshi, Managing Director, Network 18 Group. Dr. C. Rangarajan, former Governor, Reserve Bank of India. Former and present Deputy Governors of the Reserve Bank of India who are seated here in the audience, Chief Executives of banks and other financial institutions and the corporate world, distinguished members of the audience present here and those watching this program virtually, members of media from the team CNBC, Network 18, ladies and gentlemen. I'm delighted to be here this morning at the Global Leadership Summit, which marks the 25th anniversary of CNBC TV 18. I would like to congratulate the entire team CNBC TV 18 for its successful journey over the years. It's indeed an honor for me, and I repeat, it's indeed an honor for me to join this occasion to felicitate 3 distinguished former governors of the Reserve Bank of India. Dr. C. Rangarajan, who is present here, and I'm immensely humbled by his presence here. So the CNBC is honoring Dr. Rangarajan, Dr. Bimal Jalan, and Dr. Y.V. Reddy. And what can be a better occasion for me personally to be present here and watching the event. With their exceptional performance, these 3 former governors of the Reserve Bank of India, with their exceptional performance in the economic and financial sector policy making, they indeed occupy a pole position in the art and science of central banking and have left a mark not only in India but across the countries. As stewards of a full-service central bank, they initiated fundamental shifts in the monetary frameworks as well as in the financial, exchange rate, and external sector policies of the country. I humbly bow to the rich tradition and legacies left behind by Dr. Rangarajan, by Dr. Bimal Jalan, and by Dr. Y.V. Reddy in shaping what the Reserve Bank of India is today. Drawing inspiration from their contributions, I have chosen to speak on the theme, Sailing Through Turbulence, India's Tryst with Financial Stability. In recent years, the global economy has gone through a period of continual and unprecedented shocks. This was a period of great volatility, as I have described it elsewhere, quite distinct from the earlier era of the Great Moderation. Complex and varied shocks of a global pandemic, supply chain disruptions, wars, geopolitical conflicts, and climate change hit the global economy very hard during this period of global volatility. These were not typical shocks dealt with in standard textbooks or having standard policy responses. Now, sailing through this turbulent period has therefore been a daunting challenge for every country, including India. After almost a synchronous adoption of expansionary policies following the pandemic, central banks across the world resorted to an equally synchronous monetary policy tightening when high inflation bounced back in the face of supply chain disruptions and the onset of the war in Ukraine. Overall, these policies across the globe appear to have worked well. That is, these policies of the central banks in tightening the interest rates and tightening monetary policy when the war commenced, and prior to that in loosening and going for an expansionary policy when the COVID pandemic hit the entire world. I think this time around, the policies of the central bank across the globe, they have worked well. Soft landing has been ensured, but risks of inflation, as I speak to you here today, but risks of inflation coming back and growth slowing down do remain. I'm talking about the global scenario now. Indian situation has its own characteristics. I'm now focusing on the global scenario. The headwinds from the geopolitical conflicts, geoeconomic fragmentation, commodity price volatility, and climate change continue to blow. During this entire period of great volatility, which I referred to a little while ago, maintaining price and financial stability have posed difficult trade-offs, as evident among others from the banking sector turmoil in certain advanced economies in early 2023. The challenge has always been the challenge for central bankers in particular has always been between doing too little or too late on the one hand and doing too much or too early on the other. Reading the interplay between monetary policy actions and the developments in the financial sector, as well as the evolving situation correctly, and timing the decisions are always challenging. Central banks have by and large performed well this time around. In this challenging global environment, let me highlight certain contradictions globally which we observe at the current juncture. First, government bond yields, I'm talking about the global situation. First, government bond yields are rising even as many advanced economies have embarked upon an easing path through rate cuts, underscoring the fact that treasury markets are influenced by a host of global and domestic factors that are much beyond mere policy adjustments. Incidentally, even the US dollar is now appreciating, although the US Fed has started cutting rates. Second, undeterred by the strong US dollar and high bond yields, prices of gold and oil, the two commodities that typically move in tandem, are showing sharp divergence. Third, an interesting contrast is also emerging between rising geopolitical risks and financial market volatility. While geopolitical tensions have escalated steadily in recent years, financial markets have shown considerable resilience in the face of mounting uncertainties. Fifth, global trade is projected to remain higher in the current year than the previous year, notwithstanding the sanctions, the tariffs, import duties, rising cross-border restrictions, and supply chain disruptions. Fifth, emerging market economies have shown greater resilience than advanced economies in the current phase. Now let me turn to the Indian context. Amidst these headwinds and contradictions, the Indian economy is sailing through smoothly, powered by buffers like strong macroeconomic fundamentals, stable financial system, and resilient external sector. Our endeavor, that is our endeavor in the Reserve Bank, has been to seize every opportunity to further strengthen our fundamentals through prudent and proactive policy approach. Our primary focus has been to maintain financial stability, which breeds growth and prosperity. In 2019, we faced severe stress in the non-banking, that is in the NBFC sector. Liquidity had dried up and there was a crisis of confidence in the financial markets. There were also certain instances of bank stress, both in commercial and cooperative banking sectors. In all these exigent situations, the Reserve Bank took effective measures to stem the crisis from snowballing and to restore stability and confidence in the markets. In parallel, we strengthened our regulatory architecture and supervisory vigil to proactively identify weaknesses and be future ready. It is therefore appropriate to reflect on our experience during this period, not just, if I may say so, as a success story, but more importantly, to draw lessons for the future. When the COVID-19 pandemic hit us, our response was swift and decisive. We put in place business continuity measures even before the nationwide lockdown was announced. We set up special quarantine facility with about 200 officers and service providers and other staff to ensure continuity in financial market operations and in payment systems. All regulated entities were also advised to take immediate contingency measures to ensure business continuity and manage the emerging risks. Turning to monetary policy and the liquidity operations that we have undertaken during this period of continuing challenge, what I call the great volatility. Monetary policy, in fact, as we look back, has completed a full cycle in the last 6 years. An easing cycle during 2019-22 and a tightening cycle of equal magnitude thereafter. We have used the flexibility embedded in flexible inflation targeting to prioritize growth or inflation depending upon the prevailing conditions and the outlook. For instance, when economic activity came under severe stress during the COVID-19 pandemic, we prioritized growth over inflation and cut interest rates. We also infused huge liquidity into the system. These measures were nuanced, keeping in mind price and stability challenges that may arise in the future. In addition, forward guidance during the easing phase complemented and reinforced monetary policy and liquidity measures. In parallel, appropriate regulatory measures consisting of moratorium on repayment of loans and resolution frameworks for stressed loans were also announced. Later, when the Russia-Ukraine war caused massive supply disruptions in key commodities and threatened inflation to get out of control, we shifted our focus from growth to controlling inflation. We front-loaded our monetary policy actions and changed our stance to withdrawal of accommodation. We remained nimble and agile in our liquidity management operations. Further, fiscal monetary coordination, that is the Reserve Bank's rate hikes along with proactive supply-side measures by the government, helped in controlling inflation and anchoring inflation expectations. Coming to a more recent period, The MPC in its meeting on October 7th to 9th, that is in the last month, took note of the prevailing and expected inflation growth dynamics and decided to change the monetary policy stance from withdrawal of accommodation to neutral. It also decided to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The change in stance provides greater flexibility and optionality to act in sync with the evolving conditions and the outlook. Overall, while average growth during 2021 to 2024 remained buoyant at above 8%, the receding of headline inflation in 23-24 and 24-25 up to September to within the tolerance band bears testimony to the success of the Reserve Bank's policies. What is equally important is that all these actions did not undermine financial stability, and this is a point I would like to emphasize. Our rate hikes were preceded or accompanied by prudent risk management practices in the form of greater flexibility to the banks in holding government securities under the held to maturity, that is under the HTM category, that minimized mark-to-market losses. It is evident that while designing our responses to both the pandemic and the inflation upsurge thereafter, our policies were flexible and balanced. We remain consistent with our mandate of price stability while keeping in mind the objective of growth. The underlying mandate of financial stability was also adhered to. During this entire period, communication became an important tool to complement our policy actions. During the pandemic, our endeavor was to give confidence to the wider economy, to the financial markets, and to the public at large. In the monetary policy statement on April 17, 2020, in the early part of the lockdown, I had said, I quote, "Although social distancing separates us, we stand united and resolute. Eventually, we shall cure and we shall endure," unquote. We began using quotes from Mahatma Gandhi like, and I quote, "In the midst of death, life persists. In the midst of darkness, light persists." This was in April 2020. And going forward, one more quote. It's when the horizon, one more quote from Mahatma Gandhi, that it reads as follows: "It's when the horizon is the darkest and human reason is beaten down to the ground that faith shines brightest and comes to our rescue." This was in May 2022, and several other quotes of similar nature. In particular, I would like to refer to my December 2023 statement following the macroprudential measures undertaken in November last year. I quote, "Financial stability is a public good. We do not wait for the house to catch fire and then act. Prudence at all times is our guiding philosophy." The spirit behind these statements, the spirit behind such communication, were indeed key to withstanding a period of multiple crises and giving confidence to the markets. Our communication was backed up by appropriate policy actions. It's not just that, communication words were being sounded, statements were being made, but they were backed up by appropriate policy actions. Evidently, communication played a critical role in maintaining stability in the turbulent times of the recent past. It goes without saying that a sound regulatory framework for regulated entities, I'll just touch upon a little bit on regulation and supervision also. Now, it goes without saying that a sound regulatory framework for the regulated entities, whether banks, NBFCs, or other financial entities, together with a robust supervisory and monitoring mechanism, are key enablers for ensuring financial stability. From a prudent perspective, so far as the Reserve Bank is concerned, measures like the revised norms on classification and valuation of investments, the scale-based regulations, and multiple other initiatives which were taken. I'm not reading them out. It will be the copy of my speech will be uploaded in the RBI website. You can have a look at it. So all these steps together, including the steps to contain potential credit exuberance in unsecured loans, are some of the illustrations of prudent design of regulations in the interest of maintaining financial stability. Looking ahead, the financial system will continue to face newer challenges. There is a continuing need for the financial sector entities to strengthen their levels and quality of capital, while further sharpening the risk management standards. The Reserve Bank is now working on issues like the adoption of the revised Basel III standards in a phased manner, issuance of guidelines for expected credit loss, liquidity coverage ratio, that is the LCR, and prudent framework for financing of project loans. Our overall approach is consultative. For instance, with regard to the ECL framework, that is expected credit loss framework, even after issuing a discussion paper and receiving stakeholder comments, which we got examined by an external working group, we now propose to issue a draft circular for implementation of ECL. So the draft will be followed by issuance of a final circular. Again, we will get comments, and we are adopting this very careful approach because the introduction of the ECL framework marks a major transformation in the way the assets, the stressed assets or the buildup of stress, or the way the assets get classified. So considering their significance, we have decided to approach repeatedly a consultative approach. Now the idea is to get stakeholder comments on certain specifics of the framework, considering its significance for the banking sector. Our endeavor is to maintain a balance between banking sector stability and economic growth. I would like to stress this point again. Our endeavor is to maintain a balance between banking sector stability and economic growth, both of which are necessary and are complementary to each other. We are also working on climate risks and their impact on the financial sector. The final guidelines for disclosure framework on climate-related financial risks will be issued shortly. The process of supervision of banks, NBFCs, and other financial entities has also been unified and substantially strengthened with proactive on-site and off-site supervisory mechanisms. The focus is now on early detection and preemptive correction. The enhanced off-site assessment framework is more analytical and forward-looking, with introduction of macro stress tests, early warning indicators, fraud vulnerability index, microdata analytics and microdata analysis, and use of artificial intelligence and machine learning. The on-site supervision now goes, that is RBI's on-site supervision, now goes into greater depths. Direct engagement with supervised entities is enabled through discussions and also through the Daksh portal, which we have set up, which is a SupTech initiative with end-to-end workflow solution to streamline and strengthen various supervisory processes. The College for Supervisors, which was set up in May 2020, is now helping our supervisors to sharpen their skills and remain up to date with the new and complex developments in the financial sector. The financial sector indeed has become more complex with the development of multiple digital products, common market infrastructure, and common service providers for IT services. These developments have elevated both the microprudential and macroprudential risks. The Reserve Bank has been proactive in addressing the growing cybersecurity challenges in the financial sector by issuing regulations to by issuing regulations relating to basic cyber hygiene in the regulated entities, and also with regard to digital payment security controls, IT outsourcing, and IT governance. Recognizing the critical importance of data and its future potential, an enterprise computing and data center is being set up in Bhubaneswar. Alongside, a cybersecurity training center is also being set up. Further, work on setting up of the Reserve Bank cloud facility is also gathering pace. Overall, the financial sector in India is now more robust and resilient than at the beginning of the recent period of turmoil. There is, however, no room for complacency. The regulator and the regulated entities, many of you are present here, the regulator and the regulated entities must remain alert and future ready for the emerging challenges. I would now like to speak briefly on the external sector stability. India's external sector has also exhibited strength and stability in the recent period. The current account deficit has remained within manageable limit and stood at 1.1% of GDP in Q1 24-25. During the first half of 24-25, India's merchandise exports recovered from a contractionary zone in 23-24. Services exports have remained buoyant and rose by 11% during the first half of the current financial year. The robust growth in the services exports coupled with buoyant private remittances are helping to contain the current account deficit. On the financing side, net capital inflows have generally exceeded the current account deficit and contributing to accelerate foreign exchange and contributing to accretion of foreign exchange reserves. India has the fourth largest foreign exchange reserves in the world at 682 billion US dollars as on 31st October, which is sufficient to cover the entire external debt and about 12 months of merchandise imports. In terms of other key external sector indicators, such as external debt to GDP, net international investment position, and short-term debt to external debt, India's position remains resilient. Our exchange rate policy is well articulated and has remained consistent over the years. India's exchange rate regime is market determined, and the Reserve Bank does not target a level or band of the exchange rate. The forex interventions are carried out to ensure an orderly movement of the exchange rate and to curb undue volatility, anchor market expectations, and ensure overall financial stability. It is important to note that the exchange rate is also a barometer of an economy's inherent strength. If the Indian rupee has remained relatively stable despite severe external shocks, including the largest and the steepest tightening by the US Fed in 2022 and 2023, it speaks volumes about the sea change in our macro fundamentals from the days of the taper tantrum. In fact, if we look at the other major segments of the financial markets regulated by the Reserve Bank, that is the money market and government securities market, they have also remained stable despite large swings and spillovers from global markets. The weighted average call money rate has remained range-bound within the liquidity adjustment facility, that is within the LAF corridor, and closely aligned to the policy repo rate. The 10-year G-Sec yield has also moved in a narrow range of 6.72 to 7.61% during the tightening cycle amidst global policy pivot, fluctuations in US Treasury yields, and global crude oil prices. The Reserve Bank has undertaken several regulatory measures in recent years to ensure resilience and stability of the financial markets. These includes putting in place regulatory frameworks for benchmark administrators and electronic trading platforms, robust governance requirements for market makers in OTC derivative markets, and margin requirements for non-centrally cleared derivative reforms. As I proceed to conclude, let me add that the Reserve Bank has also played a crucial role in creating an enabling ecosystem for innovations in the online payment, innovations in the payment systems. This has enhanced the efficiency and stability of the Indian financial system. Introduction of 24/7 NEFT and 24/7 RTGS, the success of the UPI, and implementation of the central bank digital currency, that is CBDC pilot project, that is the e-rupee, are transforming the wider financial system. Digitalization of banking services has received a further boost from the Reserve Bank's pilot project, namely the Unified Lending Interface. This Unified Lending Interface was developed and was designed and developed by the Reserve Bank Innovation Hub in Bengaluru. A few other initiatives of this innovation hub are also in the pipeline. Let me now try and conclude. The Reserve Bank's mandate spans multiple dimensions. Our consistent effort is to take a holistic view of stability, which encompasses price stability, financial stability, and sustained growth. We deploy multiple policy instruments to serve these multiple objectives. Today, India's economic growth remains resilient. Inflation is expected to moderate despite periodic humps, and the external sector is robust. Without being complacent, let me end by saying that the Indian economy has sailed well and sailed very well through the prolonged period of turbulence, and it exhibits resilience in the face of constantly emerging new challenges. Thank you. Namaskar.
Thank you very much, Governor Das. May I please request